All right. I am here with Adam Kirsch, and he is a director at West Monroe. How's it going, Adam?
Doing great, Steve. How are you?
Doing fantastic. Doing fantastic. I'm glad we could connect here. Got a lot on the docket to cover, but before we get to the nitty gritty, let's talk about your background. What got you into the space?
Yeah, so I occupy a very unique niche in the world, and that's that I coach companies through exit with a focus on articulating the value of their technology and operations to prospective investors and acquirers. And if we really go back all the way, it starts in an interest in entrepreneurship that I think I developed in childhood. I was always selling snacks and candy in school, shoveling snow, raking leaves, whatever it may be, always trying to make a buck growing up. And a lot of that came from being a part of a family business. So my grandparents, my mom, my uncle had a business selling desserts. And growing up in a family business, I grew up far too desensitized to the idea of working for yourself that I realized this is kind of where I'll eventually end up. I ended up starting my first company in high school, managing bands and DJs and throwing concerts up and down the East Coast. That ended up pivoting into a little bit more of a digital content platform, ended up selling it when I was in college, and then started a company in the real estate software space, which ultimately ended up getting acquired as well. After that, had the opportunity to start working with a number of venture capital investors and startups in and around the New York City area. And that really got me interested in understanding what M&A looks like at a bigger scale. Through that, found my way to West Monroe, where I work now and have been for the last several years. And after a couple of years working on the buy side and working with some of the best tech investors in the world and some of the best growth equity, private equity investors in the world as an advisor, said, hey, I think there's a really good opportunity here to work with founders, work with entrepreneurs, work with companies that maybe are already sponsor owned and going through an exit process and helping them tell their story to get the best possible outcomes.
Nice. And I like that you mentioned like desensitized to the risk of being an entrepreneur at a young age. And the amount of people that I talked to that started their first business as like a lawn mowing, which was made, lawn businesses, selling candy, selling CDs, all the different things as a kid that get you in that mode of like getting a product into somebody's hands is such a fun like dynamic, and it's fun to think about how you can nurture that with kids. So I'm glad you said desensitized. I don't think I've heard anybody phrase it like that before, where you're less scared of the risk and ready to go for it, thinking that you're going to end up there when you're young is super powerful. So let's kind of shift gears. You mentioned a couple different ventures that had gone from zero to exit, and I'd like to unpack kind of the preparedness aspect to begin with here. Like, what are some things that transcended those two ventures, for example? We'll start with those, and then we can talk about some of the ones that you've worked on at West Monroe. But I'd like to know from the businesses you had, what were key pieces that helped prepare for the exit?
Yeah, absolutely. So I think in the case of the first business, right, this was something that started as a teenager and was lucky to be able to grow and ultimately sell. And really, a big part of that transaction was selling to somebody who was familiar with and comfortable with the asset. So we had somebody who had contemplated joining the business as a partner. This was an opportunity for him to get in, but he also really knew our business well, and he spent a lot of time getting comfortable with who we were and how we worked. And ultimately, right, that relationship continued into his partnership with my co-founder and their continued growth and development of the business. And one thing I think about now, especially in the current climate, is the importance of getting to know the people in your ecosystem, right? Whether that's from an acquirer point of view or simply from a business development and career development point of view, because it's really important to have a sense not just of how you might collaborate with somebody, but how you could eventually be a part of their organization one day, or they could be a part of yours. And because there was a high degree of comfort on that transaction, I think it really smoothed a lot of the things that people stress about, things like negotiation, transition, et cetera. There was such a high degree of comfort and trust already that it was really a streamlined process.
Mm, I like that. The relationship kind of being the foundation there and lowers the stress load of the transition just by kind of being friendly and getting to know each other over a long period of time. That is powerful because it is just human. It's a human deal that's going on. I think a lot of people get confused. Like, these are just humans talking to each other and negotiating, and it can
Mhm.
get a little bit blurry there for a while. So that was the first business. And the as you transitioned into West Monroe, what were some things that were kind of the translatable things that went past, let's say, the business you started when you were a teenager to $1 billion, exits? What were some of the characteristics that translated regardless of the size?
Yeah, absolutely. So it's really interesting to think about how many of the same questions I got asked selling some of these businesses I started when I was younger, certainly the software business, that were the same questions that I was asking of companies that were going through the acquisition process when I was working for a growth equity or PE investor via my role at West Monroe. It was
Mm-hmm.
surprising how many of those questions were similar in nature. And so much of it came down to, we buy this company, what happens next? And be able to articulate a roadmap and a story and a narrative that's compelling and realistic and operationally sound. And one of the things that's most exciting now as I think about working with companies going through this inflection point is being able to help them understand that perhaps what got you here might not get you there in terms of the next level of evolution. But that doesn't mean that we can't understand it, doesn't mean we can't put work in on it, doesn't mean we can't get there. So let's spend some time, put a point of view together that's rooted in what you do best. And let's figure out how to scale not just the organization, but the value proposition so that it fits into an acquirer. And whether that conversation is with a strategic, whether it's with a financial investor who wants to acquire the business, whether you're raising venture capital, growth equity, private equity, whatever it may be, or preparing for a wholesale buyout of the business, if you can have a clear point of view on what your story is and have that rooted in the reality of what you've built, that's going to go a long way. And that's true whether you're selling a company for $1,000 or $1 billion. At the end of the day,
Mm-hmm.
you need to be able to demonstrate how your roadmap matches the narrative that you want to put forward and how your operations will scale to make that happen.
Yeah, yeah. Storytelling, being able
Absolutely.
to show the story. And I think, you know, going through some of the tools that you've seen people using for getting prepared, what are some like high level aspects to, like, standard operating procedure documents? What are some of the things that people listening right now could do today to get their business ready to go for getting acquired by a bigger company or a partner or one of these types of strategics? How could they get their whole everything in order?
Yep. So one of the things I tell everybody we work with is exit readiness begins day one. Whether or not you're actively seeking an exit, you need to be in a position where you can be exit ready, right? Give yourself that optionality, put yourself in control so that when the right opportunity comes along, you don't feel pressured by its existence. You're already prepared for it in some sense. So what does this look like? I would say start putting together documentation in a data room type format. So data room is something that a buyer will ask to access before they invest in a company, basically a consolidated repository of your key documents. That could be things like SOP manuals, it could be legal documentation, it could be technology information, whatever it may be. I always let founders know, like, hey, you can get started on that for very low cost and very low effort tomorrow, and doing that will save you a ton of time down the road. It also gives you time to refine and enhance it, and you may find out even just in the construction of something like that where gaps might exist in the business that you need to spend more time on, because you'll understand, hey, you know what, this isn't clear. Another thing that I always think about and recommend to folks is if you had to think about what the right exit looks like for you, what does that look like? And it's not necessarily this idea of, you're trying to seek out that exact opportunity, but it's the sense of what about that exit makes it feel right for you, right? Do you want an opportunity where you're going to have the ability to roll equity and have a second bite at the apple? Do you really want to, optimize for your own control of the business, or do you just want to kind of make a wholesale clean break? Like, have a sense of the why, because when that conversation comes, it's going to get asked, and you need to be ready to speak to it. And the other thing that I always stress, and this is true not just for exit planning, but just generally speaking, is the importance of a roadmap. Whether you are a software company, right, that's where we tend to traditionally associate roadmaps. But even if you're a service company, an agency, really no matter what kind of business you are, you can build a roadmap that says, here's where we see this going in 12 to 18 months. And here's what we think we're going to accomplish and what it takes to get there. And that document alone is so critical because it helps you create the boundaries in which your story is told when you go into an exit setting. It helps you align a buyer's vision to your vision and figure out where there could be discrepancies that need to be resolved in an exit conversation. And it's also tremendously useful for tracking your own progress as a entrepreneur, as an operator, to understand here's what we set out to achieve. Did we achieve it? Maybe, maybe not. If we didn't, let's look back and figure out what we could do retroactively or in retrospect to address that. So I think there's a lot of power that comes from having something like that and actually taking it seriously, right? It's not just an artifact to go and be buried. It's something that you can come back to again and again.
Well said. Like a living environment. I like that, taking it seriously so that it's ongoing and just makes it less of a stressful short period of time because there's already so many ingredients going into something like this. Having all your documents in one place is a good starting point. So my favorite question is mistakes. Where where do people mess this up? Where is the kind of recurring theme that you see of exits not working out because of XYZ?
Yeah, so I think there's a couple areas that we see. And if we set aside the big common things, right, like valuation disconnect or market conditions, right? Those are always going to play a role in an exit not working out. There's a couple of areas where I think things like this can fall apart. Um, one thing is it's very easy as a founder to just live within the reality of your business, or as a CEO, as an operator, right? Your business is so much of your day to day that it's probably taking up almost all of your waking hours and potentially some of your sleeping hours. So when you're that deep in something, it's really hard to zoom out and try to understand the value, not just that somebody else is placing on your business, but understanding the landscape in which they're viewing you. So keeping a sense of what other companies are doing in your space, what comps are going for, why you may or may not compare appropriately to another business. That's really important. Having a sense of why somebody is interested, right? Are they looking at your business for a strategic reason? Do you have interesting IP? Do they want to buy revenue? Is there a geographic play or a market expansion play there? Just getting a sense for that up front goes a long way. And having a sense of your own hypotheses around what value you bring goes a long way. And being able to zoom out outside of your operations, because you may think you're doing something really, really well, only to find you're not. And we
Mm,
see that, it's not uncommon that a founder has a very high regard for their business, as they should, but they're not willing to take notes or understand kind of the market feedback on it. I would say second area where things could go wrong for somebody trying to sell a business, it's really hard to both sell a business and run a business. When you have a day job, right, and that day job is something as intensive as entrepreneurship or being a leader in a company that's going to go through this process. It's really hard to both keep your eye on the ball in that day job as well as work on a transaction. So
mm,
being able to establish if you have partners or collaborators or others in your enterprise who are working with you, understanding who's going to be that central point person, understanding who's going to triage requests coming from buyers, who's going to manage that, goes a long way. It also is really important to bring in, if you're of an appropriate scale, advisors who can help you through that process who have done it before. Because what that's going to let you do is extend your own bandwidth. And you extend your bandwidth, you can field more offers from prospective investors. You can take folks deeper in a process. And if you have more competitive processes, those tend to lead to higher exit values. So that's really important for the founder as well. And then the last piece in terms of where, I'd say the ball gets dropped or it can be challenging is a lack of alignment on that narrative and having a really clear exit thesis for the value of that business. So this dovetails a little bit with the earlier point on road mapping, but it also manifests in terms of how you as an operator are articulating the value of your company on exit. So being able to move forward with a clear sense of here's the value we bring, and knowing that if that transaction doesn't work out, there's still other opportunities to exit that could be driven by the operations that you've built today. That goes a long way. And of course, yeah, it just goes without saying, right? Don't be a jerk. People don't want to people don't want to invest in or partner with jerks. And I personally have seen at least a handful of deals fall apart on the basis of somebody just personally not liking an operator. And this doesn't say
mm.
go be yourself going through this process, but whether it's kind of excessively playing a hardball or just being generally presenting as challenging to work with, or you know just not being an effective communicator and coming off as abrasive. I think all those things I've seen create friction in processes. Be a professional if you're going through this sort of thing.
Yeah, I like that. And often I've spoken to so many different entrepreneurs who talk about either using a broker or not using a broker, and more people lean towards brokers because of that reason, where they may be, maybe you could call it prickly or a little bit a little bit unbuttoned or traditional maybe in how they operate, and that's what usually it takes to get to a certain scale, and maybe that's what their industry requires, or so on. But I think that it's such a great point that if you're just a jerk, there's a high probability that no matter how good the business is, people aren't going to want to deal with you. And even working with a broker kind of smooths things out a little bit. It makes everything clean, organized, and structured. And I've found that type of approach to be always extremely valuable, regardless of the industry. And it's a good segue into valuation, because you brought that up as one of the mistakes. And I hear that time and time again, of a misalignment. And for everybody listening, that Adam mentioned a couple key ingredients there. One is that you're grinding every day in something. So therefore, by default, you put a high value on that because it's just your experience, and the market could say something totally different. And it's kind of an emotional roller coaster for a lot of entrepreneurs. So I think that was a really good point that you wove in there, that it's very much like the valuation kind of starts out at one place, and then the market can kind of dictate what that is over time. So what can you share about valuation and how people derive that in the current state? And what kind of advice do you give entrepreneurs when it comes to pricing?
Yeah, so this is a great question. This is an area where working with a broker or investment bank is tremendously helpful, because they'll be able to give you good guidance in terms of what the market might bear for your business, because they'll have a good look at what comps in the space might look like. They're generally have their ear to the ground for whatever industries they may cover, or if they do sponsor coverage for kind of where private equity's ethos is in a particular area. I think valuation is a super hard question, right? If you're a smaller business, you're probably looking at something like a multiple of seller defined earnings. If you're more established, you're generally being sold on an EBITDA multiple, maybe in SaaS on an ARR multiple. And all of that's going to be, in many cases, very comp driven, very market driven. As a founder, you can only do so much to control the market. But what you can do is you can try to optimize different aspects of your business. So if you figure out what are the most important things that I can communicate about my business and optimize for those metrics in terms of how that influences valuation, that's very helpful. So one example of that might be in the software space, rule of 40, is your growth rate plus your margin north of 40%. That's generally an indicator you're gonna do above average from a valuation point of view. You may have specific unit economics in a physical business that matter. That's another thing that you can optimize for and drive towards. But the other thing I want to stress about valuation is figuring out as a founder, you know, where you need to exit to be comfortable. And I'll give an example of that. There was a business I advised several years ago. They had raised, not a ton of venture capital, $2 or $3 million of VC. Company got a buyout offer of in the tens of millions of dollars. At that valuation, with the amount of capital they could have raised, they could have very easily exited. Everybody would have gone home very happy. Their investors, the operator, the employees who held equity, would have been a great exit for everybody involved. However, there's that question of how do you reconcile that with the ambition to go be a $100 million business or a $1 billion business, or
Mm.
this idea of like, let's go raise capital. Ended up that the company could never get that same valuation again. They ultimately, this was kind of on the wrong side of COVID, or on the kind of they ran into the wrong side of COVID, weren't able to kind of pick that back up. I have another founder who I advised many years ago, who similar situation, had a buyout in the tens of millions, ended up raising around at that same valuation to go and try to grow, ultimately ran into market headwinds due to some regulatory factors. It's things like that you can't always predict. So you need to get a sense of where that level of risk is for you as an entrepreneur, and what level of risk is for the organization to bear. The flip side of that is you can often, you can make a lot more money doubling down, but just know that it's going to be harder and harder to get to that next evolution each time. And in some cases, you have to think about, what does that look like in terms of structurally? How do I change how I operate this business? And often that comes with its own set of tough decisions.
Mm. Yeah, I like that. Like kind of, I've heard this calculation done before, where an offer today versus a year from now, 2 years from now, what is the probability that you're going to get double, triple, quadruple, and kind of backing into what it is at that very moment for all shareholders, like not just an investor, yourself, but the team, everything. And it's such a dynamic sort of calculation. And I like that you mentioned that, because it's an underrepresented one of like what it means right now and what it means in the future, what it could be. And I think there's a lot of famous sayings around that. as to the value of it today. But I think that's really solid. So we've talked about mistakes. We've talked about getting prepared. I think the next one is timing. I know everybody's different. Every business is different. Every industry is different. But what have you seen? When is it the right time for somebody to exit?
Yeah, this is a great question. I was literally just talking with a friend of mine who's also in M&A about this exact topic this morning, and about the criticality of timing. Because you may find that your business, right, exists at a very specific point in time that's going to be compelling. And we saw a lot of folks who raised a ton of capital in Web3, for example, a few years back, and haven't been able to hit those same valuations, or folks who maybe had something that was particularly trendy in one space or another. I think one thing that you're always going to be scrutinized by in the case of an exit is, what does business performance look like for the last year? What does business performance look like for the last 2 years? How are you trending over a span of time? And generally speaking, you're going to be in a stronger position to sell when your business results are better. Perhaps not a surprise, but a lot of founders kind of think about, I'm only going to sell my business if I'm getting a massive paycheck, or if I'm getting out. And that kind of binary thinking makes it very difficult to kind of contemplate things in the middle. What I would consider is just making sure that you're doing kind of a pulse check on what other companies that are in your space are doing, right? So if you're seeing a lot of M&A activity in your industry, or you're seeing a lot of venture capital activity in your industry, generally a good sense that's not a bad time to, either raise capital or transact. If you have a particular business that's linked to regulatory factors that may influence positively or negatively other, macro tailwinds or headwinds, having a sense of that might be a good time to act on it. And then I think the other question is for you as an entrepreneur, right? Like, exits don't happen overnight. You need to be planning months, if not a year and a half in advance of when you actually want to take that step. Now, if you kind of maintain an exit ready approach throughout your operating period, that's going to give you more optionality in when you can go. Because some of these deals can come together very quickly, some are going to take a long time. But if you're doing three things, right, and those three things are, maintaining your exit ready approach, right, having your documentation ready to go, having an effective roadmap, two, building relationships, right, understanding the investors in your space, understanding other operators in your space or investment firms that play in that world, and then, finally having a sense of what's exciting for you personally, what's compelling for you personally, and being able to bring those three things together, that's going to tell you in your gut if it's the right time to go. Ultimately, from a market timing point of view, you're going to get your best results if you're selling off of, at least a year, 2 years of good results and positive momentum. But if you're in a space where maybe there's not as much growth, then it's, how do you make the business more profitable? Okay, if it's, now we've made the business more profitable, it's okay, what other opportunities are there? What value might a buyer bring? And those are the questions you have to be ready to proactively answer and think through. And it's one of the things that I'm excited about, is being able to talk to entrepreneurs and operators and talk through those exact questions.
Yeah. Yeah. Excellent. That was awesome. So that takes us to the finale question. We talked a little bit about what you were going to say before we started recording
Yeah.
with the finale, but knowing what you know now, what would you tell Adam 10 years ago?
Yeah, I mean, I think I certainly would have loved to get into Bitcoin, and probably, would have needed to have exits. Would have been a very different situation there. Probably a lot of high risk, high reward. But no, in all seriousness, I think one thing that I wish I had placed more value on, and now I see the importance of it every single day, is the value of having that roadmap and being able to track. And when you get asked the question, how do you know you have a competitive advantage, or how do you know you excel? Be able to cite something real about, here's how we know we win, right? Whether it's
Hmm.
specific proof points from the market, whether it's unique IP that gives you differentiation, or whether it's simply just having a great track record of execution that's backed up in the numbers. And the ability to demonstrate a track record of success with a compelling roadmap for the future and tell the story of how you get from one point to another, that is something that will not just be of value in the context of an exit, but really in running your business every single day. And I encourage everybody listening to keep that top of mind when they wake up tomorrow and go to work and have to operate. Think about that and think about all the good things that could come from it.
Very nice. Very nice. Well said. Well, those are all the questions. What are you working on now? And any side hustles or anything? And where can people learn more about what you're doing?
Yeah, so absolutely. I mean, I think number one thing, right? I run the exit readiness and sell side advisory team at West Monroe. We have the opportunity to work with a number of great investors and companies as they go through that next stage. So we're bringing folks with a mix of sell side due diligence and executive coaching focused on technology and operations as they hope to take their businesses to the next level. I've had a phenomenal time there advising on many, many exits, and many more to come in 2025. Outside of that, do some angel investing. So always love checking out startup companies that I find exciting. So that's a broad swath of businesses, but generally most excited by founders who are really a great fit for their market. Look at a lot of SaaS stuff, things that dovetail with themes of SaaS, the cloud, infrastructure, data, cybersecurity, sustainability, et cetera. Love looking at deals in those spaces. And then, most importantly, trying to give back to the community. So outside of my work with West Monroe and some of my angel investing, volunteered with Cornell's entrepreneurship program and with the Network for Strategic Entrepreneurship. So Network for Strategic Entrepreneurship, Nifty, NFTE.com, great organization if you want to give back and make a difference in the lives of young people who are interested in business. So try to stay busy, Steve.
Very cool. Very cool. Well, wherever you guys are listening on iTunes, Spotify, the links that Adam mentioned will be in the show notes. But thank you so much for coming on and sharing all your wisdom, Adam.
No, I appreciate it, Steve. Thanks for having me. And to anybody listening who wants to connect, come find me on LinkedIn.